the yield curve has inverted, and more importantly, how can we overcome this? And for today's content, I've prepared 5 key points. Number one, we will know the difference between what is an interest rate and what is a yield. And number two, how to tell that when the yields are inverted. And number three, why it is important to note yield curve inversion. And number four, what is the long-term trend for interest rates and yields? And number five, how to manage a rising yield. And before we get into today's topic, please take some time to read through the disclaimer provided here or below. Now let's get to the first part. What are the difference between an interest rate and a yield? Now I have prepared this here. That's right. Now, say for example, we have to understand that the interest rate, they are a benchmark for borrowers. For example, like myself and for most of us, when we make a purchase on our home, usually we'll pay down a deposit and we'll borrow most of it from a bank. So therefore, we will be keen to know that what is the prevailing interest rate that we will be paying month after month on our borrowing. So as a purchaser of my own home, I'll be interested to know what's the interest rate because I am a borrower. Now, how about the yields? Now, yields are for lenders. Say, for example, again, myself or for most of us, if we invest in a corporate bonds or a US government bonds, we will be interested to know what are the yields. If I'm going to invest in this 30 years yield bonds, what is the yield that I'm getting every year? You know, what's our interest rate that we are getting? So make no mistake, don't be mistaken that the interest rate I'm referring to, yes, is a pay to me, but when it pay to us, this is what I call the yield. And we have to understand that both the interest rates and the yields, they move in tandem together. Meaning if interest rates on the rise, now as an investor, now remember the borrowers are keen to know what's the interest rate. When the interest rate is on the rise, as an investor, I'll be also keen what are the yields that I'll be getting. So they will move in tandem together. Now let's move on to the second part here. The key number two is that now how to tell when the yields are inverted. Is the yield currently inverted? Now this is a live demonstration that I have here. Now let's look at what happened to beginning of 2022 on this 30 years bonds. 30 years bonds yield. Yeah, 30 years bonds. The yield that we're getting at the beginning of the year, it was, now note that it was January 2022 here, it was 1.9%. Now let's look at the 2 years yield. At the same period in January 2022, it was 0.77%. Now it is pretty obvious that if I invest into a longer time frame, a longer tenure, it is expected that I'm getting a higher return because my commitment as an investor is longer term. I'll get 1.9. So I get a payout of more, 1.9% as a yield. And it's reasonable if my commitment is just about 2 years that maybe the banks, in this case, the government is going to pay me 0.77%. So we could see that 30 years are higher and 2 years yield are lower. And that's why I call a healthy yield, a yield curve. Now, when will the yield be inverted? And that's what we're seeing right now. Okay, now pay close attention to this right now here, is that we could see that the yield at the moment is about 3.57 for 30 years yield. Now, if a banker come to me, say that, ask me to invest in this 30 years yield, and per annum, my interest that I'm be receiving is 3.57% as of now, compared to if I'm going to invest into a 2 years yield, the tenure for 2 years, and the current payout is 3.99%. And guess where will I put my money down? I would want to put at 3.99% because it's paying me more interest rate. My return, my yield is more than the 30 years. And definitely I'll go for the 2 years yield. And that's kind of complete the point number two, is that how can we tell the yields are inverted? So based on this comparison between the 2 years and the 30 years at the moment, when the shorter end, they are higher than the longer term end, and that means that the yield has inverted between these two yield. So now, then point number 3 is important. So why is it important to note that there's this yield curve inversion? At the moment it's inverted. Now, why is it important to know? Then we have to understand this is that, let me just give you this example, is that when a 30 years yield is lower than the 2 years yield, which is happening right now. Now, this indicate for the lenders or investor that there's this pessimistic outlook. There's a reluctance to commit their money to the longer term bonds, and we prefer the short term deposit as the market is unclear in the long term. Now, how about for the borrowers here? Let me just move this down for you to understand a little bit more. Now, for the borrowers, that most individual or companies have shorter term borrowings. For example, in the country I'm staying here in Singapore, and when I make a purchase for a house, there's only two options on borrowings. Either I go for the float rate or I go for the fixed rate. And the common fixed rate is that 2 years fixed rate. And that's considered short term. But we do not have many options here. It's either float rate or fixed rate at 2 years. Or for a company could be a bridging loan. A bridging loan means that a short-term borrowings. Now, these are about 2 years or shorter than that. Now, so what happened when the yields are inverted? It means that suddenly the borrowers, whether it's an individual or company, we will find ourselves paying more on interest rate repayment. So I hope that that brings some light to how to understand about yield curve and what is the impact. Now let's go to point number 4 is that, so what is the long-term direction, the long-term trend for interest rates or the yield? Now let me just bring you back to over to this chart here, that we could see that this is a 2 years yield, 5 years, 10 years, and 30 years yield. Now, and very interestingly, you could see that at the moment, the 2 years is about 4 right now compared to the 30 years where we discussed. And how about the 5 years yield? 5 year yields right now is about 3.7 and is also higher than the 30 years. Then how about for the 10 years? 10 years about 3.5 is about on par with the 30 years right now. Let's look at the 30 years, and technically, how can we tell that where is the 30 years heading? Have this 40 years downtrend, has it broken? And obviously that we could see that there was a downtrend over the last 40 years on the 30 years government bonds on this yield. Remember that the yield and interest rate, they are moving in tandem together. Now, let us exercise what we have covered over the last many videos about how to draw a downtrend line. There are two rules. The first rule is that we try to find the significant peaks, at least 3 of them, at least. And then the number 2 rule is that we try to find the best fit. Now, let's see if the downtrend line has been broken. Now, first, you got to start off with, you have to find a point to get started. And then the second point, then you're going to try to play around with it. Now, we try to find 3 significant peaks, at least. Then you try to connect the dots, try to find the best fit. Right? Now I'm going to extend here a little bit more. Now I kind of like this. Maybe here. Maybe we're going to shift this back. I'm going to extend this. Okay, I'm quite happy with this here. Now we could see that there was 3 significant peaks. It touched at the high, it touched at the high, and this one it touched at the opening price here, and that's considered significant peaks. Now, and we could see that how nicely that it trend down over the last 40 years in this downtrend on the 30 years yield, and this is a 3-month chart, means that it's a quarterly chart. And also see that how nicely that the second quarter of this year in 2022, and now we're in the third quarter, it has convincingly broke above this downtrend line. So technically, I would say that the 30 years yield at the moment, it has, since the second quarter of 2022, it has technically broken away from this downtrend. We have never seen this before over the last 40 years, and maybe it's just at the beginning. So if you're going to ask me where's the long-term trend for the yield, I would say that likely it's going to move up. It could be something like this. That means from a downtrend, you have transit to an uptrend. Go ahead, clear this. Let me shift it. I'm suspecting that along the timeline, it may do something like this here. Okay. Yeah, that's what I mean by the downtrend is a lower low, on the uptrend is a higher low. So I'm expecting something like this. And let's go back to the rest. And the rest, you can apply the same strategy. You'll try on the 2 years, 5 years, 10 years, apply the same two rules. First, you try to find the significant peaks, at least 3 of them, if not more. Then you try to do the best fit. And you realize that whether is it 2 years, 5 years, or even 10 years, it has the same behavior. It has all broken the last 40 years downtrend. So I hope that you find that it's interesting here. And let's go over to point number 5. So how are we going to manage this rising interest rate yield or rising yield? Now, there are many ways to hedge into inflation or a rising yield or interest rate. And one of the way is a direct hedge. And that's what we could see that there's a 2 years yield, and that's what we studied earlier. And below are the micro, in this case, is 2 years micro yield futures, and this micro 10 years yield futures. And I'm going to move to the daily chart. And I'm going to expand this because obviously we could see that the one that's draw the most interest is the 10 years yield futures. How will you know that you draw a lot of interest is that you got to look at the volume here. And let's study into this. And this is a daily chart. Somewhere in July this year, they just launched this contract, which I'm pretty happy about it because for the first time, there's somewhere I could hedge into a yield. Yeah, the rising inflation rate, and seems like they seems to know that the interest rates on the rise. There's an opportunity for investor or traders like myself to hedge into the market. So how to understand this contract is that this contract is called the micro 10 years yield futures. It's quite a mouthful here. Now, first of all, we have to understand that the contract spec states that every 0.001 point is equal to $1. If at the beginning of this month in September, say it's about 3.2, and I'm expecting that the yield is going to continue to rise, I may want to buy into this micro 10 years yield futures at about 3.2, and now it's about 3.5. Say, for example, I'm happy with it. I want to take a partial profit on one contract. So you could see that from 3,005 minus 3,002 is 300 ticks times $1. So my profit will be $300. Of course, on the flip side, if I make a wrong decision, if I do a sell short, then my losses will be at $300. Now, let's go back to what we have first discussed here. I'm starting a series about inflation. So in the next tutorial, we will discuss about why inflation is happening, not just in the US, but all around the world. Continue to explore this topic with these related videos and register for these webinars as well. Follow my Facebook page for my daily market insights. To be updated with my latest video, subscribe to my channel and remember to turn on the notification bell. See you again very, very, very soon.